Maybe let's just start out with the immediate data that's to come this week. We've got PCE coming on Friday, and if you look at the most recent batches of inflation prints that have hit, they have actually surprised to the downside. They're coming in lower than what people had been anticipating. So how does that, cement the case for rate cuts in the second half of this year?
Yes, so I think you're right, Joumanna. I mean, inflation has been benign. At least the last two prints have been benign. And what we've been seeing is that we are seeing an easing in goods inflation while the services part of it is still sticky. Now, with the PCE data that is due this Friday, I think it will continue the trend. We will continue to see flattish trend in PCE, and we expect it to be fairly benign, which makes a stronger case for a Fed rate cut. Now, when exactly this will happen is still a question mark for us. And the reason for that is that we do not have a very definitive direction from all the data. And Fed, as it always says, they look at the totality of the data rather than one data point. Inflation, of course, we know PCE gauge is the most important gauge that they look at.
Yeah.
But at the same time, they also need to look at other economic data as well. And we saw that industrial production was very strong. We saw the PMI data, especially the services side of that, was strong, while we saw slight cooling down in the labor market. We saw retail sales a bit weaker, and we saw housing starts being a bit weaker as well. So there is a mix of data here. There is no definitive direction which is pointing to the fact that, yes, a rate cut should be the next right move for the Fed. But, yes, it makes the case stronger. And we need a few more data points where after which Fed can definitely say that, yes, we are looking at a rate cut.
Yeah, and still soft landing scenario. It wasn't that long ago that everyone's talking about the potential of a hard landing recession, but all of that's been completely blown out the window. What do you make of this market pricing and the fact that these five-year forwards are expecting a much higher terminal interest rate than what the Fed themselves are guiding to? What sort of implications will that have on financial assets?
So I think in general, we need to be mentally prepared for a higher for longer interest rate scenario. Now, of course, like you mentioned, the Fed projections have the neutral rate at about 2.75%, while in general, the market is projecting it to be at 3.7, 3.8%. Now, this is something that can be a topic for debate. The neutral rate is not something that can be decided over a short period of time. It is something that requires a longer period of time to come at a right estimate. And even then, it is not something which is so easily estimated. Given by the way economic trends have been, the economy has been fairly strong despite higher interest rate, 525 bips of rate hikes, and yet the economy performs. No talk of, like you said, hard landing, soft landing being the key scenario. So clearly, there has been something in the economy which has kept its strength. Maybe the interest rate endurance has been higher, or maybe it is also the fiscal spending, which wasn't accompanied, last time when we saw this kind of rate hikes, we did not have as strong fiscal spending. So there are a lot of factors to consider. But yeah, as of now, definitely this is a topic for debate.
Yeah. I see in your research that you still like owning U.S. equities. Let me phrase the question as a question of how you think the U.S. will perform versus their European equities counterparts. Because what we've seen in the last couple of weeks is a lot of political premium is being priced into European equities. They have started to really underperform versus the U.S. after a good start to the year. Does that change once the French elections are out of the way, do you think, and then people start focusing on U.S. elections? Or is that premium in the U.S. just going to stay?
So I think, the outperformance of U.S. equities year to date as compared to European equities, I think the reason for that has been some very strong underlying trends, underlying themes which have really propelled these equities. We all know about AI and the hype around that, but we do believe it is a real trend there. Now in Europe, there has been substantial reason, actually around maybe 15, 20 days ago, maybe a month ago, the narrative was forming that, yes, finally the European equity should start outperforming and US has a bit of froth now. But then we saw the debacle that happened in France, and we saw that, the entire sort of, snap election scenario kind of muddied the picture for Europe. And that has been the issue with Europe. There's always something or the other which, in a way, muddies the picture and makes the path forward a bit less clear. Yes, French equities and in general European equities have underperformed going into this, and we do think there will be some opportunities once the elections are out of the way. But as an overall geography, we are selective in Europe because we feel that there are certain sectors which will do well, but as a whole, Europe will still underperform the US.